Hey there, everyone, and welcome to the latest episode of our Market Misbehavior podcast. I'm your host, Dave Keller. I'm the President and Chief Strategist at Sierra Alpha Research and founder of Market Misbehavior. I really have enjoyed launching this podcast in 2024 with the goal of sitting down with top market practitioners, traders, money managers, strategists, analysts, educators, authors, anyone else that will sit down with me virtually or in person and talk markets, talk strategy, and talk their approach to investing. It's already been a really fascinating ride, talking to a number of people with very different approaches, different markets of interest, and just understanding a little bit about how they're approaching the current market environment, trying to answer a lot of the questions that you and I are asking as well. Today, a really fun discussion with a options trader, educator, and author, Nishant Pant. I met Nishant through CNBC. We're both CNBC contributors. Nishant writes for the options product. I write for the chart investing product. And connecting with Nishant, I was immediately drawn to his very straightforward approach to analyzing options trades, to structuring options trades, using technical analysis. I've known a number of people that are obviously very good at technical analysis. I know a lot of people that trade options. Nishant is one of those rare people that I think combines those two and is able to talk about the relationship between the charts and an options trade very, very well. Nishant is the author of Mean Reversion Trading, using options, spreads, and technical analysis. Really enjoyed reading his book in preparing for this discussion, and enjoyed asking him, sort of sharing some of the quotes from the book that were of interest to me, and allowing him to expand on that. Nishant's background is as a software engineer, and it's funny, talking with Tom McClellan on this podcast last year, we talked about how there were some consistent backgrounds in the technical analysis community. A lot of pilots, and I would attribute that to the fact that it is a very, structured approach to doing something. You have to make decisions without emotions being a primary driver in those decisions. And so pilots are very comfortable following checklists. And I think investors and traders are well served by doing the same. Another group would be musicians. And I would say it's a mix of creative background, but also the mathematical nature of music, and especially as Tom and I discussed, someone who focuses on taking visual content and elevating it to something else. Right, you're reading notes on a page and turning it into something beautiful, and so that relating to visual representation, but sort of expanding on that, I think is very true. Then the third would be engineers, programmers, developers, people coming from more of an engineering background that are drawn to the mathematical and statistical nature of technical analysis. These are the guys that tend to design indicators. These are the ones, in my experience, that are often drawn to the options market, because it is, in a lot of ways, a mathematical discussion, right? It's a bunch of numbers thinking about volatility and time decay and price sensitivity and figuring out the optimal solution based on a ton of different potential levers you can pull. So I talked with Nishant a bit about that. We talked about technical analysis as a weather report, which he talked about in his book, and thinking about going from the macro perspective, right? What are the overall markets doing, to more looking at sectors and themes, and then getting to individual stock and ETF ideas. And I thought the way he described that was very, very well done. We talked in specifics about looking at different technical indicators, which ones Nishant uses, and how he structures options trades based on the technical configuration. We went through one particular example of a vertical spread, what's called a bull call spread, basically taking two call options, buying one, selling the other. And we look at an example using the material sector ETF, the XLB, a trade that he put on, and how he did it. So I thought it was a really cool opportunity to do a case study on one particular trade. We talked about a lot of the nuances of the options market, why using vertical spreads can minimize the time decay, which is often an issue if you buy what are called naked calls or puts, just sort of buying an option on its own, and a lot of other things along the way. So please enjoy this conversation with Nishant Pant. So I am super excited to sit down with options trader and educator Nishant Pant. Nishant, it's so good to meet you, and I've read your book, and I really appreciate what you've done. I think sharing some wisdom for individual traders. But it's so good to sit down with you virtually. Thanks for coming on the show.
Thank you so much. I'm very excited. Thank you.
So tell me this. I hope people are familiar with your book, and hopefully, if not, they are after our discussion. But let us understand a little bit about your background. How did you get to this point? You're a CNBC contributor. You're somewhat of an expert in terms of some of these mean reversion option trading. How did you get to this point?
Okay, so as I was telling you earlier, I'm a software engineer by profession, and I don't know, for some reason software engineers get drawn to trading. I don't know what it is. There is something,
Yeah.
but my trading journey started in 2008, I think, or 2007 maybe. So, I made all the mistakes that every trader makes. So, started with pink sheets, believe it or not, pink sheets.
Oh
That
boy.
didn't go well.
Yeah.
Didn't go well. I I learned
Okay.
very quick that that's not how you do it. Then I
Right.
started just getting into blue chip companies, just well established stocks. And then I was starting out with a very small account, so around maybe $2,000. And I quickly realized that, like even if I figure out what's the right time to buy a stock, I don't have any money in my account. Like I need like hundreds and thousands of dollars to buy, the before all these splits that happened, like Amazon, Google, they were trading at $700-800 a share.
Mm.
So I was like, even if I buy it, like how much money can I even make by just buying stock? So then I was like, there must be some other way. And that's when I ran into options. And what options, as you know, what they do is like, you have tremendous amount of leverage.
Mm.
And even with a small account, you can trade options. So I mentor a lot of people these days, but even with a $1,000 account, you can easily trade options, no problem. So I got interested in options because of the leverage. Then again, like I was telling you, all of us have to go through this painful journey of making our mistakes, blowing up our accounts. So I, just like everybody else, I've started buying call options and put options, and that didn't go well either because I didn't understand the three-dimensional nature of options. They have all these, time decays built in, implied volatility. Many things can go wrong. And so then what I did was I was like, okay, why is everybody going through the same painful journey of learning trading? Why is this nobody sharing a way that's not everybody has to repeat the same mistakes? So what
Mm.
I did was I spent a lot of years developing a proper trading system. And by trading system, what I mean is, it's not about finding the right stocks to trade. That's just one piece of the equation. Once you have the trade, being able to maintain consistency and not
Mm.
blowing up your account through corrections, and also with when you're dealing with options, because they come with all these Greeks, and they expire. So without getting a PhD in the Greeks, how can you trade options and with a small account? So I did
Mm.
all of these things. I developed this trading system, and that's what I have documented in my book. Like that book basically shows you how to get it, how to find the right stocks to trade options, how to get into options trades. Once you have an options trade on, how would you manage it? How do you manage winners? How do you manage losers? So that's all I have shared in that book.
I love it, and it's really well done, and I appreciate so much. I'm gonna grab a couple pieces of this that stood out to me as I was going through it. To start off with, we're obviously in a very interesting market environment here, right? In January of 2025, I feel like while the VIX remains fairly low, the emotional volatility for a lot of investors seems very, very high because there's just so much uncertainty. Well, in your book, page 105, you said, whether you are a pilot of a plane or the captain of a ship, no matter what your skill level or experience is, you always have to pay attention to the weather report before heading out for a trip. I think that's a brilliant way of describing it. I'm a student pilot, so it completely clicked for me. Can you talk to me a little bit about with this specific strategy? And we're going to go through a couple examples, which I think are really, really interesting. But how do you
Okay.
sort of combine the macro, like what is happening, all the question marks we experience, versus specific levels to put to work on a specific trade? How do you bridge that gap?
Okay. So the way I approach things is, and I have watched a lot of your videos too. You have this really nice macro view of the market,
Mm.
and that's where I start too, my due diligence. So
Yeah.
my first step is develop, spend some time understanding the markets, develop a long-term bias of where the markets might be heading this year. So at the highest level is that, and I truly believe in the saying that a rising tide lifts all boats. So you have to first figure out the tide. So and that's what I meant by market weathers, right? So first of all, whatever your understanding of the market is, whether it's macroeconomic environment, geopolitical issues happening, wars happening in the Middle East, inflation, high inflation environment, high interest rate. So based on that, you form a overall view of the market. That will give you a bias, whether you are bullish or bearish. So once you have that bias, then I filter down to the next level where I go into individual sectors. So because the thing is, the sector rotation is a real thing. So there's always money flowing into certain areas of the market. So then you need to figure out which sectors money is flowing into. And one of the things I think you have talked about in your videos is, RRG charts, sector rotation graphs. So I find them really interesting. I have implemented my own way of figuring out which sectors money is flowing into, but I do pay attention to that a lot. So then I select the top performing sectors, and then I have my list of stocks that I trade. I have a fixed list of stocks because I do options. So not every stock is suitable for trading options. So I need high liquidity. I do need weekly options. And so that's how it goes. So market first, then individual sectors, find the strong sectors, then go to the stocks, and then look for technical setups in those stocks. So the reason I like technical analysis so much is, fundamental traders and technical traders, they don't look eye to eye for some reason, and it doesn't have to be that way. I think both of them have their own place.
Yeah.
So fundamental analysis will tell you which stocks you need to trade, but it doesn't tell you when to trade. Technical analysis tells you exactly at the point where a stock might be about to go up or pull back. So technical analysis gives me those entry points. So in my book, I have mentioned just a handful of indicators. I think 2 or 3 indicators I use to figure out, and the book is called Mean Reversion Trading. So there are many ways of making money in the market. Like you can do trend following. That's one way. You can do mean reversion, and the basic concept of mean reversion is very simple. So when stocks go up or down, they don't go up in a straight line or down in a straight line. So they go like this, a zigzag. So with mean reversion, the whole concept is you find an average. So if the stock is going up like this, you find an average, and I use an indicator called Bollinger Bands for that, and it just plots a 20-day simple moving average and 2 standard deviations around it, and forms like a cloud, and that captures almost entire price movement of the stock. So you use that, and then every time a stock tends to move away from the mean, like 2 standard deviation move, it, like most of the time, it tends to revert back. So the whole concept of mean reversion is it's a contrarian mindset. So when a stock is stretched to the upside or downside, you take the opposite trade. Now, just because it's stretched doesn't mean that it's going to revert back. So that's where technical analysis come into play. So for example, I use an indicator called relative strength index, RSI. So let's say a stock has dropped on some bad news. Now, it has dropped doesn't mean that you go bullish on the next day. So RSI indicator, for example, will tell you when that downward pressure is losing steam, and it will actually start guiding you that the stock is about to go up. That is the point you enter a bullish setup. So that's how I marry technical analysis and so if you at this point, if you just stop here, right? So if you use technical analysis to find mean reversion trades, you can just buy stock at that point. You don't have to buy options. So what I do is I use options as my trade structure because once I go through a couple of trades that we have, what I like about options is I use something called a vertical spread, first of all.
Yep.
And that trade structure that I use is really simple. I think it's the easiest trade structure ever. So you don't, there is nothing complicated to learn. It's not a multi-legged trade, just 2 legs. And what it does is it shields you from a lot of the Greeks that people don't understand. For example, employed volatility, time decay, all those things get kind of canceled out because you are doing 2 options at the same time. You're buying an option and you're selling an option. The option that you sold almost cancels out all the Greeks of the option you bought. So if you're just buying a call option, the same example I gave you, stock dropped like crazy. RSI is telling you it's going to go back up. mean reversion setup. If you just buy a call option at that point, you can do that. But if the stock doesn't go up like a vertical move up, you will lose money because of time decay. And that's where the beauty of spreads is, because you just get shielded from that. So anyway, that's how you use technical analysis and combine it with options. You have a question?
No,
Looks like you
I'm
have a
super
question.
excited.
Okay.
Yeah, I'm super excited to look at a couple of these examples, Nishant. As you were talking through your process, you outlined things very, very well, and what stuck out to me immediately was I have a couple indicators that I use, and in your book I had underlined where you said I started out using 12 to 15 indicators, and my signals were all over the place. It took me many years to narrow it down and use a combination of just 5 indicators to gauge the market. Can you talk a little bit about, because I know that's something that I feel like most of our listeners, if they look at charts, you kind of run into that issue where you sort of have analysis paralysis. You're kind of trying to look at everything, and all of a sudden you have no usable signal. Can you talk about that process to where you identified these indicators as most helpful? What drew you to them, or what successes did you have that helped you understand, okay, this is the way I'm really going to understand how this stock is trading going forward?
Yeah. So I remember I bought a massive, I don't remember the name of the book, huge book on indicators, technical indicator. I read through every single indicator. I think maybe there were 200 indicators documented in that book.
Right?
So, and every indicator you read about looks like this is it, in the holy grail of trading. This will do the trick. So
Yeah.
that's how I started, and I applied all of the indicators to my screen. It was so confusing to watch. And like I said, signals were all over the place. So
Yeah.
then I started, it's a painful process of narrowing down indicators to what works for you, because no indicator is wrong and no indicator is always right either. So you need to, based on your personality, you need to find out which indicators work the best for you. In my book, I've also mentioned that there are categories of indicators. So for example, there are momentum indicators. So there are volatility indicators. So if you pick up a handful of indicators from each category, sometimes it helps provide confirmation. What I see many traders do is they will find like 5 indicators from the same category.
Yeah.
And what happens is it's almost like a self-fulfilling prophecy. All the indicators will tell you the same story. So now although you think there's a confirmation, but there is no confirmation because they are from the same bucket of technical indicators. So you need to borrow from different buckets, and that's how you add confirmation to a trade setup.
Yeah, no, that's well said, Nishant, and that's a common issue I've seen with a lot of people, and I feel like we all kind of go through that journey where we try to use a little of everything, and all of a sudden you realize you're just all of a sudden you're just giving yourself a reason to take some action, and the behavioral biases you're trying to avoid, you're somehow magnifying them by just by duplicating signals. So I think you walked through that evolution very, very well, and to be honest, I think the combination of indicators you highlighted, for those that are familiar, it's some mean reversion kind of envelope techniques, right? Like Keltner channels, like Bollinger Bands, tried and true approaches for identifying extremes. It's RSI, a measure of momentum. It's something like, DMI or MACD, one of those trend following indicators. So kudos and thumbs up from your host here, saying I think that it's a beautiful approach that I think you've lined up,
Thank you.
And indeed hit on different areas very well. I'd love to go through a couple of these examples that you shared ahead of time, if we could. Let's bring this up. You have a couple that we highlighted. The one was in the materials sector, which I think was a really interesting one that kind of combined some of the things that we were talking about. Can you talk us through the technical setup and then just explain how you would have structured, or how you did structure an options trade for this particular technical configuration?
Yeah, so this is a trade on XLB, material sector, right? So it's an ETF. So I trade ETFs and stocks both. What I love about ETFs is that they are extremely liquid. So they offer something called a dollar-wide strikes. So options have option chains, and those chains list strikes. And the nice thing about a dollar-wide strike is that I'll show you the trade that I take in the end. So you can take a trade which risks as little as $50 per trade. And that's why, like, the people I mentor, I always tell them, trade small. When you're learning something new, do not risk too much money. Take a trade which risks only $50. Anybody can digest a $50 loss. and then start from there. So this particular trade, let me go to the chart. So what I've done in this particular chart is there are three EMAs at the top, the blue, yellow, and pink. And at the bottom, I have two indicators. So one is the RSI indicator. So RSI below 30, you see a yellow line, that's a 30 line. When RSI drops below 30, a stock or ETF is officially considered oversold. And that is the time when you need to start looking for mean reversion setups. Now, like I mentioned earlier, just because it is oversold doesn't mean it's going to bounce back the very next day. And in this case, you will see that RSI went into oversold a long time before it came back up. So once it goes below 30, you just go into waiting mode and you watch it and wait for RSI to pop up above 30 for you to consider a trade. So the stuff that I've highlighted and circled, at that point, RSI is going up. That means there's a good likelihood that this stock might bounce at that point.
Right.
To provide confirmation is always a good thing. You use support, resistance, you use multiple indicators, you can use that. In this case, I've used an indicator called MACD. And MACD indicator can be used in different ways. So it can be used to gauge whether a stock is in primarily a bullish phase or bearish phase. There are blue line and yellow line. So there is a signal line and there is a MACD line. When the MACD line is above the signal line, the blue line is above the yellow line, it means it's in a bullish phase, a stock. MACD can also be used to find mean reversion setups. So when, let's say in this particular scenario, the blue line is below the signal line, that indicates that the stock is primarily stuck in a bearish momentum.
Yeah.
When the blue line crosses over or below that signal line, that's called a MACD crossover. That usually represents a strong trend change coming up. And this MACD crossover is very reliable when you're considering ETFs. It's very good for stocks too, but especially for ETFs, which they're so liquid. In my opinion, from experience, it's very reliable signal when that happens. So in this case, that's your confirmation. You get two confirmations that this downtrend might be over and might be time to go bullish. So now that we have identified that we want to go bullish, then how do we use options to go bullish? So for that part, what I have done is I've only shown you the technical chart, but in this particular trade, what I did was the ETF was trading at $85.16 at that point. So typically what I do is when I go bullish, when I buy a call spread, my expiration, because options have expiration, I choose an expiration between 25 to 35 days. And there's a reason for that. There is a saying called bulls take the stairs up and bears take the elevator down. And what that means is when markets go up, they go up in a slow, timely fashion with minor pullbacks in between. So it takes some time for markets to go up. But when some war on Ukraine, something like that happens, right? So markets suddenly drop when the bad news comes out. That's why they say elevator down, because markets suddenly drop, and it's very hard to place yourself in a position to take advantage of those sudden drops. Yeah. So I prefer to take bullish trades, and when markets go into pullback, I just go into waiting mode and just wait for markets to do their thing and then just again go bullish. So going back to this example, stock was at 85.16, and what I did was I bought an $85 call option. And then since I do spreads, I also, when I buy a call, I also sell a call at the same time. So I sold an $86 call option. So stock price is right in the middle of 85 and 86 because it's at 85.16. So what that does is, this structure does for me is it allows me to buy a spread for $50. And the math is also very simple here. So the math is like this. So I bought the 85 call, I sold the 86 call. So there is a difference of $1 between my strikes, right? 86 minus 85 is 1. So when you do a $1 wide spread like that, the cost of that spread is always the strike width divided by 2. So $1 divided by 2 is 50 cents, which is basically $50. So that's my cost. If I were doing a $5 wide spread, so I bought an 85 call and sold a 90 call, then the cost would be $250. So just divide by 2.
Got it.
So figuring out the entry prices is very easy. It's always fixed. $1 wide, $50, $5 wide, $250. Now, how do you make money on this trade? That's the beauty of this spread. So look, 85.16 is the price. The stock, I bought 85 call, I sold 86 call. If by expiration date, the ETF expires at or above $86, that means it doesn't even have to make a dollar move. I will double my money on this trade. So the trade returns a 100% ROI with a $1 move. Imagine if you were buying a stock in a company which is trading at, let's say, $500 per share. For you to double your money, you need a $500 move in that stock.
Right.
With this option structure, you need a $1 move and you can still double your money. So that is the beauty of like what the leverage that options provide you. And the way I've structured this trade is by selling a $86 call and buying an 85 call, I've canceled out all the Greeks, which is why option traders lose money, because they don't understand how implied volatility works, how time decay works. They don't understand all of these things. So by constructing this spread, you have shielded yourself from the Greeks too.
This is such a great example. You hit on so many different things in here, Nishant. I'd love to tease out a couple of those points. I mean, number one, you mentioned a number of times about the Greeks, and again, this is I feel like when people learn about options and then start to hear things like theta and time decay and delta and gamma, their head starts to fume a little bit. They get a little bit nervous because of all this. But I think you laid out very, very well. And that idea of time decay is something you don't get in plain vanilla equities, which is there's an expiration. There's a moment where this is no longer active. And if you're just buying, correct me if I'm wrong, you're just buying a naked call option, it has an expiration. So every day you get closer to expiration, there's that time decay where the value's declining just because it's getting near expiration. But a call spread like this, you basically cancel that out because you have the two contracts. And so the theta, the time decay, is sort of erased. Is that fair?
Yeah, that's so true. And the thing is, in this particular example, XLB, imagine that when the stock started turning up, it actually goes sideways for some time and then goes up. So what will happen is if you just have a call option, every time the stock is going sideways, it's like holding a melting ice cream in the sun. Your option is losing money every day.
Yeah.
But when you have a spread, the option that you sold is also losing money. So the one you bought is losing money, sold is losing money, but it's canceled itself out because the guy who you sold it to is actually paying you money. So
right.
It's a really amazing, very simple structure. So what I do is I don't confuse myself by indulging in complicated option strategy. I just use it to place a trade. That's it. My main time spent understanding the markets and doing technical analysis and finding entry points. And then I just use the simple trade structure to take my trades.
And the bull call spread that we just kind of talked through here, and again, correct me if you are the expert, but from my understanding, you're kind of limiting your upside, right, in terms of the upside definition, but you're also limiting your downside, right? So can you talk a little bit about the risk management side of this and how that actually allows you to limit, the downside as well?
Yeah, I think it's beautiful. So the thing is, most people, when you tell them about vertical spreads, right? So if you tell them I'm capping my upside, people just don't like that for some reason. They're like, no, I just want to make infinite amount of money. But the thing is, first of all, it's shielding you from the Greeks, which I told you.
Yes.
And then I'll give you one more example. Let's say you did buy a call option and the stock started going up. At what point will you pull the plug on that trade? That's where most traders struggle with. They don't have any clear profit targets defined for themselves. So when a stock goes up, they think, oh, you know what, I'm making money, so let me hold on to it more so I can make more money. So what that does is that actually ends up hurting you, because what will happen is a stock will not go up like this. It goes up, then it'll pull back, then it'll go up, then it'll pull back. And when it starts pulling back, you never know that is it just a pullback or it will keep going down from here?
Right.
So people get stuck in a trade out of, I would say, for the lack of a better word, greed, because they don't have a defined profit target. So for them, the profit target is actually infinite. So they just want to keep holding on without realizing that a stock can go down. If you have a call option, you are actually losing money every day as the expiration comes close. So even if it's going up, you may still end up being a loser. So what this does is, by having a capped profit target, once you get to the target, you know you can't make any more money. So there is no question about when to pull the plug on that trade.
Right.
So when I open these trades and my expiration is 35 days, 25 to 35 days. At that point, I place my closing order at 94% ROI, and the order just sits there. Whenever it's time to come, it automatically closes. So there is no guesswork on my part to figure out at when to close the trade. The opening price is fixed. The closing price is also fixed. So in this particular example, I opened my trade for $50. I would immediately put a sell GTC sell order for $97. That represents a
Mm.
94% ROI on that trade. Now, what I also do is, in my book, I've presented this entire trading system. So every winner gives you 94% ROI. Every loser, I cut a loser at 50% loss. So if any
Right.
trade loses more than 50%, I close it. And the beauty of this is that it generates positive expectancy in your trading system. So let's pretend that you have a really bad way of identifying trades and your win rate is 50%. That's pretty much a coin flip. So you
Right.
flip a coin. If it says heads, buy Apple. If it says tails, sell Apple. Even if you have such a horrible win rate, 50%, and every winner is doubling your money and every loser is only dropping your value by half, you will still make money. So that's the beauty of having fixed upside and downside targets. 50% loss for losers, 94% profit for winners.
It's so interesting, Nishant, as you're talking through that. It really hits home. I'm sure for a lot of the listeners here, because I feel like often as equity investors, we sort of once it begins to work, you go into hope as your investment strategy. You just hope it continues to push higher, but you really don't have a game plan for taking profits, for exiting, for sort of defining a successful trade. And unfortunately, that means a lot of people hold them too long to where they're no longer a successful trade. I think the framework you're talking about gives more of a structure that I think is kind of part of the options market, is using strike prices, using expirations, kind of triangulating those with the charts that we mentioned. Nishant, this was awesome. I feel like we just scratched the surface, so I'm going to start off by saying I really hope you can come back again, and maybe we'll look through a bear put spread. We'll look through some other examples and help people
Sure,
understand
sure.
some of the different approaches. So I hope you'd be up for that.
Oh,
Um,
yeah, absolutely. I would love that.
but this was fun. Your book's called Mean Reversion Trading, which, again, I very much enjoyed. I'd strongly encourage people to check it out. We'll put a link below in the description so people can
Thank you.
can take a look at it. But really well done. And I appreciate how you, in a very straightforward way, described what I think for a lot of traders new to options can be very confusing. I think they'll probably feel better, hopefully, after watching this, but also from reading some of your comments. Where can we point people, Nishant, to learn more about you and your approach and your educational opportunities?
I'm sorry, say that again.
Where can we point people to learn more about you and your work
Oh, okay.
and find out more about what you're doing?
Yeah, sure. So my social media handle is the mean trader.
I love
I'm
that.
not a
Again,
I'm not
well
a
done.
mean guy.
The nicest guy I've met so far, the mean trader. But well done. That's very, very point on.
Yeah.
Well done.
So I'm on YouTube, Twitter, Instagram. So you can find me there, and my website tradingextremes.com. I have documented a lot of, I would say, hundreds of examples of the kind of trades I do, and it's for free. You can go to Trade Examples and find those examples and learn my method if you're interested in. Yeah. So the tradingextremes.com is the website, and my social media handle is out there.
Very, very good. Would encourage people to check it out and follow you on all the social media platforms. Nishant, great to connect with you. And again, I hope we continue the conversation later this year. Okay.
Yeah, thank you. Thank you so much.
So it's a lot of fun. I feel like, on podcast interviews like this, you often just scratch the surface on, or have to generalize a great deal on specific topics. We don't really, we don't give ourselves the opportunity, or I don't give us the opportunity to dig a little deeper into a specific trade or specific idea. I found this, sort of opportunity as I was meeting Nishant and talking with him about what a discussion could look like, and the idea of going through in detail through one particular trade, thinking about the technical indicators, how the chart was set up, how the options trade could be structured based on the technical inputs, I found was a really fun opportunity. So I hope you enjoy that. I think that was a rare look at someone who really knows the material, who has literally written the book on mean reversion trading, showing how he would structure a particular trade. A lot of really interesting themes in that conversation. Besides that case study of an individual trade, thinking about going macro to micro using technical analysis at the beginning of our discussion, I thought was really interesting. I loved his points about how he developed the particular technical strategy, which indicators he used and why. The issues that I find a lot of amateur technical analysts, people just getting started, often make those mistakes of trying to look at too much, to look at too many indicators. And when someone, when I start to work with someone and they share with me a chart they're using and it's got 15 different indicators, my initial answer is, okay, you've got to simplify big time. You need to get rid of about 2/3 of the inputs on this chart and simplify and get back to the basics, the basic foundational principles of technical analysis. And I think our discussion today, Nishant and I, hopefully gave you an idea of why certain indicators work really well together. And it's by looking at different types, different styles of indicators and combining them. I don't trade a lot of options in my own personal trading. I attribute that less because of lack of interest or lack of understanding of how helpful they could be, but it's more most of my investment process I developed working for big financial institutions where we couldn't trade options and I couldn't trade actively. And so I, developed a process as a medium-term investor because it allowed me to trade how I needed to, and I didn't have to, worry about short-term issues that my employers would not appreciate. I wasn't able to use equity derivatives in a number of the shops that I worked for, and so I just couldn't use options at all. But talking to someone like Nishant, it really helped to illustrate why the options market can be so beneficial, particularly for individual investors looking to, thinking about costs that are involved, looking for low-cost ways to access different markets, and thinking about the return versus the risk. And I think, to Nishant's point, I think what's great about options markets and options trades, using particular strikes, using approaches like a vertical spread, give you an opportunity to clearly define your potential reward and clearly define your potential risk, something a lot of equity investors, including myself, often can struggle with. Great conversation. I hope you enjoyed that one. Again, his book is called Mean Reversion Trading, using options, spreads, and technical analysis. We have a link in the description to check out his book, and I hope you'll take a look at it. As a reminder, if this sort of discussion piques your interest about technical analysis, if you've been trying to apply some of these technical indicators that we discussed and others as well, and have struggled, or you're looking for a better, more structured way of understanding the market, what we say improving your situational awareness as an investor, our Market Misbehavior premium memberships are designed to help you out. 3 main benefits to the premium membership. Number 1, a series of members-only reports, our weekly flight plan, which is our main report evaluating market conditions as they change week over week, our monthly chart review as well, where we apply our proprietary market trend model to a bunch of different asset classes and ETF charts. We have a series of virtual courses which we'll have full access to, including all of our previous webcasts where we've gone through bull market checklists, bear market checklists, particular indicators, sentiment, breadth indicators, different approaches, and just sharing some wisdom and some market conditions and approaches with all of you. You have access to all of those virtual courses. Finally, a members-only community. It's an active community. I'm in there every day. A number of my other premium members may come in and answer questions if they feel so moved, but it's a really supportive and interesting, engaged community navigating the markets together. I hope you'll consider joining us. Go to marketmisbehavior.com/premium for more info. Make sure you use the code podcast when you check out for a special deal on your first 12 months on any plan. That's it for today. For Market Misbehavior, I'm Dave Keller. Have a great one, and remember, it's always a good time to own good charts.